Let's see. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing contained in this webinar or set of promotional material will constitute promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services and meant to teach the risks and potential rewards of trading options. And we are not a service that tells you what to trade. We are not implying guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By access to this webinar, you agree to wholly above harmless. Many losses you may occur as a result of the information discussed in the media identified above. By access to the webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously. We will not distribute or sell your information to anyone. All right, let's make this a good one because I'm not doing one next week. Okay. Let's see what's going on. At the moment, we have a bit of a pullback, but nothing so severe. But very nice because this morning I said we should short at 25,600 and play for the crossback under with a stop at 25,620, which obviously we never hit. And I said we pull back 120 points, and we pull back a bit more than 120 points, and we have stopped out because it did come back over 25.5. So we took half when it was lower, and now we've taken half off, and we're done. So the trade's over basically. I don't have any particular reason now. All right, well, let's talk about that. So now, why did I think it would pull back? Well, first of all, it was very simple, really. I looked at yesterday's move and said, well, you went from 25 to 25.4, and so half of that move. So if I figure that it's likely that you're either going to decelerate or you don't likely accelerate when you had a big rally. Usually you decelerate. You decelerate usually by about half. So even if we have a very strong rally, and even if it's going to keep following through, it's still fairly normal that if you had 400 points yesterday and stopped, that today it would be unlikely to have more than 200 points before you stop. So another 200 points, and we stop. Tomorrow, if we come back to 25.6, tomorrow I bet we have 100 points and stop until it finally fades out. Then you start looking for the retracement. So when you see a decelerating curve, and the same thing goes to the downside, you'll see a 5% drop, then a 2.5% drop, then a 1.25% drop. It's just the same thing as a 5% rule, really. It doesn't usually accelerate. A big move will usually decelerate after something's made, especially when it's based on a news event like what we had yesterday, which was Trump, the China thing, and the government shutdown. Both seem to be making big progress. So we had a huge day yesterday, and the enthusiasm doesn't die. It just kind of fades out on day 2 and day 3. So even if you're having a huge move, that's where you are. And how much is it going to be? 800 points, which is just about 2.5%, right? Because 800 divided by, so 800 divided by 25,123, 3.2%. So it's a good move. So really 25,123 times 1.025. So 25,625, that's another reason, by the way. So the 2.5% line was 25,625. So that's, again, it was why I wasn't expecting it to go higher than the 2.5% line. So there are two good reasons for it not to go that much higher. It's you have the 2.5% rule, which is the same as the 5% rule. The 5% rule applies to 5%, 10%, 2.5%, 1.25%, and the more liquid something is, the more it applies. So in other words, like Apple, very liquid, it applies in smaller increments. The index is very liquid, applies in smaller increments. When you look at a stock, though, a normal stock, not Apple, when you look at a normal stock that's maybe not that heavily traded, probably you're not going to get the 1.25% line is not going to be very significant. You know, but the more liquid something is, the more the small line. So even 0.625, half of 1.25, even that is significant on an index. So every little half fraction down is significant at that point. And it's no different than the Fibonacci series. It really isn't. It's a very similar concept, but this is a Fibonacci series. As a Fibonacci series applies to nature, this is the 5% rule is the Fibonacci series applied to computers. You know, slightly different numbers because of the tendencies computers have, but otherwise it's a very, very similar concept for retracements of growth. And Fibonacci has the same thing. The larger your sample size, the more likely you're going to hit the lines. And if you have a small sample size, it's much less predictable. So there, you're all caught up. What was I saying? I don't even know what I was looking at. We were looking at, oh yeah. So that was what I came back for. I wanted to explain why did I pick that? Why did I say that? And so why I said it is because here we were, and we were up 100 in the futures at, where's 8 o'clock? So I'm writing the post here, and we're up just about 100 in the futures, and we're consolidating. I can see, zoom in. Okay, so while I'm writing my post between 8 and 9, I say, what are we doing here? We're consolidating for a move over 2,500, 25.5. I can see that we're consolidating for a move up, not a move down, because we're pushing along that 2,500 line. So I said, well, then what's likely to happen? If we're consolidating for a move above 2,500, then probably we can test 2,600, but 25.6 or 25.6, and then at 25.6, we're probably going to have a proper retrace. How much is a proper retrace? 120 points of the bigger rally. Of the 600-point rally, a 20% retrace is a weak retrace. If we hold this line, it's actually still bullish, and we're going to go higher. So I'll tell you now, if we hold this line now, if we hold the 25.5 line, which we're not at the moment, but barely below it, but if we hold the 25.5 line, you could actually play bullish to 25.6 and probably 25.7 tomorrow. All right, but I don't feel bullish, so I don't want to make a bullish bet. That, by the way, is another thing we were talking about, like making futures bets, okay? I'm not agnostic in my futures bets. I make my futures bets based on, A, there has to be a good setup, but B, there also has to be a news flow that I see where direction is somehow changing or means something. So yesterday it was very obvious we were going up. Today, I said, well, the news flow hasn't changed, and there's nothing really to derail it. And what you also have to do is look at other countries. Look at Europe, who closes before we do. Where's their charts? So Europe had a good day, but they also faded out. All right, and we're having a good day and we're fading out. So Europe tells us a lot of times what's likely to happen in the U.S. market. Okay, they topped out in the morning and they fell down and they came back, but they stayed where they stayed below where they topped out. And we're kind of doing the same thing right now. So we may come back with one of our usual end of day rallies, but we're probably not going to get much over the highs. All right, but if we're still up at 25.6, which will be up 175 as far as Europe's concerned, when they wake up tomorrow, they'll say, oh, look, the Dow finished up 175. They'll rally a bit higher, we'll rally a bit higher, and we won't be seeing a retrace until 25.7. But then we're going to play that line short. And if we don't get that line, then I'm not sure what's happening, so I don't bet. That's the most important thing. The most important thing to learn about the futures is that most of the time you shouldn't bet. Most of the time you should look at the chart and go, I can't really tell what's going on, so I'm not going to play. That should be your default setting on the futures. If you sit there and look to play them, you're going to force yourself to make a bad bet. It's like when you go to Vegas and they have sports betting. Now they have sports betting everywhere, but it doesn't, even if you went to a bar and had sports betting. The point is, you're sitting there looking at a big scoreboard full of all the different teams and all the things and blah, 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 and it has plus and minuses and how many points they're going to get and so on and so forth. And you're there, you're in Vegas, you're sitting there on Sunday. It's only going to be Sunday today. You're in Vegas today. This is your only chance to play football betting. So you play, even though you don't have anything really obvious. Not even if you look at the board and say nothing is strikingly obvious that is mispriced, you still play because you're there to play. And the same thing happens when you come and sit down to trade. If you're there to trade, you'll end up trading, not necessarily for the right reasons. And it's very hard for me too, because obviously people are subscribing to the service, so people expect to see trades. That's my job, is to come up with trade ideas. But I realized a couple of years ago, several years ago, fortunately, that it was more important for me not to trade than to force trades. I did for a while. I was making too many trades, especially when we did the top trade alerts at first. I realized my problem was I was constantly looking for top trade alerts, and instead of just letting them happen. And I find when I let them happen, they happen often enough, and I'm 80% successful in my top trade alerts, versus where when I would constantly try to put out a trade a week, or at least one or two trades a week, I wasn't always picking optimum trades when we were down like the low side, I think 60% or barely 60%. 60% is great. If you're right 60% of the time, you can make a freaking fortune. But if you're right 80% of the time, then anybody can make money, and that's kind of the goal of this top trade alerts. So but it's all about selecting your spot and waiting. Like I said, with oil, I'm waiting until 55 to short. If they can't hit 55, I'm going to miss my chance to short. But I'm waiting to 55 to short. Natural gas, we started buying it. It keeps falling, but this is definitely my spot for buying natural gas. Coffee is finally down where I feel comfortable getting it down. It's down at 102 now. They're really, really pathetic, but it's a super low, so I like that. And we're playing KCN19, which is July contracts. Gold and silver, not particularly anything there. Copper, I think we talked about last week that I liked it. It's gone up nicely. Oh, well, maybe not last week, but I don't know. I remember we were talking about copper at some point. So copper's, is moving back up a little bit. Natural gas, we'll look at that in the bigger picture too. I mean, natural gas is so low that, we started really accumulating it last week, and I'm really into it for the long term. If this thing gets back, I mean, this is $100 per penny. So you're looking at 260. If you get back to 360, that's $10,000. So I like it. I don't think it's likely we're going to go below 250, and I think that we could very easily go to 350. Wait, I'm sorry, 360 would be up here. That's what I did wrong. But anyway, so this is a $10,000 move from here to here, and I think that's probably one of the best ideas for trading right now. Is just playing natural gas into the fall. Here we're playing the NGV, which I think is October, NGV 19. And that one's more like 275 or something like that. Well, let's see what it is. No, I don't have any NGNs. I have NG delete V. I hope I have two of those. Yeah, there they are. Oh, and they're up. Oh, how nice. Okay, so my average entry is 274. So from a few days ago, we had it 274. That's a roll though, because I took a loss. I had the regular front month NGs. I lost a few thousand on those. This is my fallback position, so I rolled to longer strikes. I was hoping to get a big move up this week, and we did actually. We got it right there, but unfortunately I had rolled, so it was too late, and that was that. So I'd already rolled into these. So I'm still behind on the whole, but like I said, we're talking about, I'm not looking for a little teeny tiny move. I'm looking for a move of like 50 cents. That'll be $5,000. So that's, and 10,000 on two contracts. So I'm taking my loss in stride at the moment. But that one I think is a great play. Look, the thing about it, the thing that backs up the NG play is that natural gas, is that the liquefied natural gas, they keep opening more and more shipping terminals to export it from the country. So aside from the normal cycle that'll bring back natural gas, we're going to be drawing more and more gas out of the country, and shipping it overseas. Now, let's see. Brian says GLD butterfly. GLD, you mean the gold ETF? That's interesting. Let's see if he's right. GLD. So what are the criteria for a butterfly? We were just discussing that in chat. In a butterfly play, we want something that is short-term volatile, so it has a lot of up and down moves, but on the whole, it stays in a pretty reliable channel. And the reason you want that is because you'll get some good short-term movement in the front months that you're selling calls and puts on, and you take advantage of the channel. So in other words, when it's low in the channel, we buy it. When it's down in the channel, we don't buy it. Gold's in a rising channel. Doesn't rise too fast, but it's something I don't mind taking a bullish spread on, actually. If you look at the longer term, it's actually locked in a smaller channel, but this is a wide channel. So what you have to do is think about, can I afford this kind of move? So the first thing you always want to do is look at how badly can I get burned in a month. So you always look at the last few months and say, look, how much? $5 move here, $5 move there, $5 move there. So $5. So $5 is a big move for gold. All right, and now given that, I want to see how much can I really make betting it doesn't move $5. So if I go look at April, I say we're at 123, and I can play the 127, which is quite a bit out of the money, and I can sell the 120. See, the puts are not good. But I don't really want to sell the puts, actually. If I'm looking at a gold play, I don't mind being long and selling short calls. So let's focus on that. If I sold the 127 calls for $1, what would I do for a long play? For a long play, I would be bullish. I wouldn't even sell puts on gold unless it got cheaper. I'm sorry, I wouldn't sell short-term puts on gold. I don't have a problem selling long-term puts on gold. So what can I do to make it worth it? What was that, in April? So April is 60 days. So if I sell $1 every 60 days, I'm not going to sell $1. I wouldn't fully cover though. That's the problem. So if I only sell, I'd probably do a half cover and I'd sell 50 cents every 60 days. So that's 6 times a year. So $3. So I can make $3 a year. So how much is it going to cost me to make $3 a year? And if it's not clear, tell me, because I'm just trying to explain it quickly. But so I'm going to want a bull call spread in 2021. I think gold's going higher, but not all that fast. I want to pay as little premium as I can and sell as much premium as I can. So if I sell the 123s, that's going to be 12, it says 1232 here. I don't know how liquid they really are. That seems a little low in the in-betweens. But these guys are 1205. See, now here's another thing. See, the delta is 63 cents. So if he's 1205, which seems realistic, then he's not 1232 because the delta is 60. So the next one should be 1265. So 1265 is a more realistic number, but that's not right. That's weird, okay, because you're not paying 65 cents. There's no way we're up to 1265. Oh yeah, I'm sorry, it could be at the high end, 1265. And if that's 1265, then that should be 1320, and it looks like it probably is 1320. And if this is 1320, then that should be 1390, and that's the high there. So you can see that the deltas are kind of reflecting the move. So the question is, I want to pay as little premium as possible, but sell as much premium as possible. And how much is it going to cost me? And here's where the problem is with gold, okay? I can't really construct a cheap spread. Unless I was more bearish on gold, because the 140s, for example, are 580. and I could probably get away with 9.80 on the 128. So that's a $12 spread for $5. No, I'm sorry, for $4. Then it becomes reasonable to make that play. And not only that, though, but I could obviously offset it with some short puts. But is that going to be worth it? So let's say, for example, we went with the 128 for 9.80, sold the 140s for 5.80. That's a $4 spread. And we sold half as many of the 116 puts for $3. That takes it from $4 on the spread minus 150, half of 3. So we'll end up spending $250 on the spread net. All right. Now, how much money is my margin? That's important too. I don't think the margin on gold is very much. So if we sell 10, let's say, at $3, that's going to cost us $16,000 in buying power. That's kind of yucky. I don't like that. That's the problem. So it's costing me $16,000 in buying power, and all I'm going to be able to pull out of that is basically $4 a year. I'm sorry, 4 times. So we do 20 on the spread. I'm sorry, we do 10 here and 20 here, and we sell 10. Then we're going to be able to pull $1,000 for only about $4,000 a year. So we sell these 127 calls. Let's make sure we got that right. That would be 1,000. Oh, if we did it 6 times a year, though, it's not really 6 times a year. Yeah, it might be. It's too much. It'd be 5 times this year, so 5,000. I don't know. I think we can do better. It's good. It's close. It's something close. But you have to look at all those factors. So unfortunately, this is how long it takes me every time I want to think about it. And plus, I have to look at it. Gold is an ETF, so it's different. But if I have to look at a company, I have to think about the chart and the earnings and where they are and how they're likely to report. There's a lot of thinking that goes into these things. It just, I know we can do better. Although, honestly, the VIX is such a problem right now that there aren't very many good plays. I'm having a real hard time finding stuff. But that's why there's always kind of breaks down at some point. That's where this breaks down. It really is like, wow, do I really want to tie up 16,000 in margin just to make 4,000 or 5,000 a year? Because and it's not guaranteed you're going to make 4,000 or 5,000. You might make 0. If you get blown out if gold suddenly pops and you get blown out, and you end up having to roll 4 times before you get even. You didn't make any money this year, but you tied up $16,000 in margin. That's a fail. So I prefer to find things where I'm not likely to fail. And again, the problem really comes down to you can't sell the short-term puts on gold. They don't pay enough. I don't mind selling the 127s for $1, but I sell the 123s, which are right at the money, for $1. So that's not worth my risk. Because then I know one of them's going to be wrong. If I sell both of them, one of them's probably likely to be wrong. And it's not that easy to predict where gold's going to be at any given time, on any given date. So, the chance of getting blown out and having to roll and wasting time and so on and so forth compared to the very narrow reward that we're getting there, that's what kills it. So good idea, just not, that's why that one doesn't work. So we'll have to hopefully find a better one. But yeah, that is how much work I have to do just to figure out whether or not I like something. Now, RTY, what to do? Nothing, Jal, that's the thing. If you don't see it, if it's not obvious, you don't do anything. That is the correct move. The correct move is nothing. The Russell, if anything, should be catching up to the others. So if the others were clearly breaking out, which they're not, then the Russell is the one that's behind on the 200-day moving averages, which we can see from Jean-Luc's chart, which is Oops. This chart. Oh, what did I do? Okay. So where's the Russell? Way down here. Anyway, so he's at the 200-day moving average. He's at the 200-day. He's over the 200-day. He's at the 200-day. He's at the 200-day. He's below the 200-day. Therefore, obviously, if you're looking at the tugboat model, so you always think of the S&P as being the ship. Okay, because there's where your market cap is right here. So the S&P is the great big ship, and these guys are all tugboats. And then the NYSE is also a ship, frankly. They're really the same in size. So figure these two guys are the ship. These guys are the tugboats pulling the ships. And they can run off in different directions, but they're not likely to get too far because they all have those lines, right? So all the boats have a line, and one boat can go up and one boat can go down, but they can both only go so far away from each other and away from the ship before they yank on each other and then snap back. So if you see two boats going one way and one boat going the wrong way, it's more likely the other one's going to go the wrong way. So at the moment, every boat is pulling to the 200-day moving average except the Russell, which is lagging behind, going the wrong way. Or it isn't really going the wrong way, it's going the right way, but more slowly. So it's being yanked on that invisible, on that line, the same direction as everybody else. And as long as they're all pulling in the same direction, he has no choice but to follow. Okay, that's what I mean when I talk about tugboats. I'm like, he has to go. He can't stray that far away from these guys. All right, and how far away is he straying? Well, he is 10%. These are 2.5% line. So he is 2.5% or more below that. Below the others. They're all at the 200. Doesn't matter where they are number wise here. What matters is who's at their 200. Everybody's at their 200 but him. He's about more like 3% or so below. So if the other guys start going over the 200-day moving average, the easy bet is to say the Russell's going to go higher. And if the Russell clears 1550 and all the others are over their 200-day moving averages, then it is likely that you can make a bet on 1550 on the Russell to go up to the 200-day moving average at 1600, which you would be paid $2,500 per contract. It's not bad. See, easy. These are not hard. This is not hard stuff. All right. That shouldn't be there. Where'd my box go? Oh, there it is. I lost my comment box. All right, Joe, so that's basically what you do. Butterfly Walmart, Brian says. All right, let's look at Walmart. Brian, we can't do 50 things here. You do it in chat, okay? Because every freaking trade, we can't go looking at it for a butterfly. So let's take a look at Walmart, though, just to do the exercise. Just going to shout out names until we hit one, right? Walmart, unfortunately, has severe moves. That's right there is disqualifying. 13% in less than a month. And they did it again. This is more than 13. This is more like 15% in less than a month. Then they come back 15% less than a month. How can I play that? That's a disqualification already. It's almost like you can't find a month in which they didn't make a 10% move. So unless I'm being paid 10% to take that risk every month, which I very much doubt, then I wouldn't play it. So how much am I going to get paid in April for 2 months to take the easy thing to look at is how much am I at? $97.50. So here I'm going to get paid $3.35 and $3.35. So I get paid $6, and that's not even close to 10% of the price of the stock. So it's just not enough premium in that. That moves too violently in the short term. All right, I agree it does kind of qualify in the long term. Because it kind of is in the sort of like a channel that it goes up and down, but that channel is just too wide. That is too crazy. So unfortunately, that one is a no. Okay, because you're not always going to get it right. And sometimes you're going to get burned on your puts or your calls. And on this one, you'll probably get burned on both at some point. And once you get burned, you're not make any money, and then you've got to take time to get back in track because you have to roll out of trouble, and that means that you have a dead position. It's not generating any cash. The more you have dead positions, the less money the portfolio is going to be able to generate for you. That's the only way it does make money is from generating cash. So once you get it wrong, you have to understand this before you start. How does the butterfly portfolio make money? You sell front month premium. How do you lose money? The front month premium you sold doesn't cover the move the stock makes. Now, you can recover from that by rolling, but the long position generally is a neutral position. So we're not making money on the longs, we're losing money on the shorts, and if we don't catch up soon, we're not going to make enough money to cover what we spent on the longs. Okay, it's tricky. You can't just take any old, that's why there's only 4 stocks in the butterfly right now. You can't take any old stock and do that. It's very tricky, and this has been a very bad environment for making those kind of plays. Unfortunately, but still, again, which I'm demonstrating, there is nothing more reliable than a butterfly portfolio. It is just an amazingly wonderful way to make money. But you have to be super patient, and you have to only buy once it makes sense, and you have to just, grind it out month after month. You grind out those gains. Let's see. Yesterday at 4 p.m., you gave bullish bearish indicators. Did I? I gotta subscribe to this newsletter because I apparently say a lot of really good stuff. All right, let's see what I said yesterday at 4 o'clock. Get a little punchy by the end of the day. I don't know what I said. Here we go. I'll leave that picture. All right, so he wants me to look at 4 p.m. That's far down. That's today. That's 11 a.m. That's 1 o'clock. Oh, that looks like my 4 o'clock stuff. All right. So what did I say at 4 p.m.? That wasn't a prediction. Is that what you're saying? Bullish and bearish indicators. Those are just the 200-day moving averages. They're the same ones there. I mean, they changed the daily, but those are just the same moving averages we have every. That's where the 200. Oh, I said that right here. These are the 200-day moving averages. I was implied that these were also the 200-day moving averages. The point was to see where we were and are we making constructive progress or not. And we are. Actually, we're not, because the S&P is lower than it was yesterday. Is that possible? Higher. Okay. So everybody's punched up a bit, and we've improved. So we're in better shape than we were here. I said, watch ES closely in the overnights. They'll show us the way tomorrow. The NASDAQ will confirm a bullish move, and anything red on the ES is going to be a bearish rejection. I say 2720 is a significant breakdown, and we're up to 2680, not 4% for 2640. Where were we? 2743. Oh, that was already up 2%. So the key is, I said, watch ES closely in the overnight. They'll show us tomorrow the way, whichever way they're going is where we're going to go. NASDAQ would confirm a bullish move, and anything red is bad. So we go back to futures, look at the indexes, and look at what they were doing overnight. So what happened with the S&P? After the market closed, the S&P went higher, stayed up, okay, and that told us that things were going to be good. The NASDAQ also higher, held up, confirmed. And in fact, the NASDAQ held up better than the S&P did in the down move. So these were bullish signs. All right, and we made constructive plays. And then again, that's why I was bullish in the morning. So we held up nicely overnight. I just followed my own advice. We held up nicely on the 200-day moving average, so there's no reason we wouldn't push higher. Unless the news flow changes, unless there's suddenly some bad news, unless there's something negative happened, it's not likely we're going to reverse course the next day. You have a momentum. It's fine. We were going up, and we're going to keep going up until something counteracts it, or until the rally exhausts itself at a key inflection point where something can't get over. So at the moment, we're pretty much right at those two. We're still right at those 200-day moving averages. Doesn't prove anything yet. It'll really mean something we close the week above on all the indexes. That'll be very bullish. If we can close the entire week above it, that'll be a bullish sign. Okay, that's what Tom said. Okay, great. So what do we do today? Today we looked at a couple of portfolios. Oops, now I gotta go back to today. Boom. And back. And back. At least I have a good web connection. There we go. Okay. I have 1 gigabyte internet. Well, I don't really see that it's that much faster, but it's at least I can say it doesn't. I don't really hit any slow spots. That's a good thing about it. This morning I was talking about this, which is something I also talked about yesterday that was bothering me. You know, when you see delinquencies for credit cards cranking up, and see 18 to 29, they're digging into those credit cards. That's college kids, 39-year-olds, they're digging into their credit cards. 40 to 49, digging into the credit cards. 60 to 69, digging into the credit cards. Everybody's digging into their credit cards. That's not good. Okay, that's kind of where we were here. Okay, in middle of 2007. And if it gets much worse, look how fast it deteriorates from there, right? It can get really bad really fast. And what causes that was people start losing their jobs. And in fact, this is going to really jump up now because of the government shutdown. You've got you have a certain large amount of people who have to dig into their credit cards to get by for a month. They'll pay it down, hopefully. But you know how that goes. Even if they get their paycheck, like, they're going to run up a credit card balance. And most people live pretty much paycheck to paycheck. So if you run up a credit card balance of a month's salary, and then you get your month's salary back, even if you get the check for the whole month's salary, now you're coming into tax season, and people are going to want to hold on to some money, make sure they have enough to pay their taxes, which they probably would have been saving for. You know, usually in January, spending slows down a bit because people start worrying about paying their taxes. And then you got to look at, so when the credit card bill comes, they have a minimum, and the minimum is what most people end up paying. So it's not, they often won't catch up, and that's bad. It's great for the banks, but it's bad for the people because they're paying a lot of interest that they weren't paying before. But you know how it is, like, people say, oh, I don't like being in debt and blah, blah, blah. But meanwhile, when you have a $5,000 credit card balance and it says minimum payment $200, you're like, oh, I'll pay the $200. Meanwhile, though, $200 is interest only, and at the end of the year, you pay $2,000 of interest on your $5,000 balance. You haven't caught up at all on the balance. That's why those things are evil. people just don't understand how bad that is for them. Auto loans into serious delinquency. And these are, by the way, don't forget, these are delinquents by 90 days. These are very bad delinquencies. And that means people are getting hit with fees and penalties and blah, 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 piling up the debt on their accounts. Auto loans, also bad. Okay, we sold too many cars to people who couldn't really afford them, and look at what happened. We went from 2% delinquencies to 4% delinquencies. That's bad. That's what happened when you oversell autos. You jump up like that, and we go through cycles where we extend credit, then we say, oh, we extended too much credit, then we extend credit, then we go extend too much credit, then we extend credit, then we extend too much credit. And that's how the auto industry goes through cycles. And we knew that, though. We knew that, like, for these years, and that's why we went long on the car companies here, because we said this was several years of people not buying cars. Eventually, people have to start buying cars again. So for the last few years, it's been good, and we had the expected recovery in cars. But I don't know if we can go through another downturn because these guys aren't stretched yet, but the kids are stretched. And cars have gotten much more expensive, much more expensive. And financing terms are not as good as they were. I know all this because Jackie was looking at cars. Jackie has, in the end, opted not to get a car for now because we ran the math, and it's cheaper for her to save money up and get a better car. She was actually willing to pay the insurance. I was going to buy her a car, but you know, I was going to buy her a car for something like $10,000, $15,000. I told her, and but instead she's going to save the money and hopefully get a better car in a year or so. And she's working, so instead of the insurance money she would have to pay, she had to pay the insurance and gas. So instead of paying $300 a month for insurance and gas, basically, she's gonna be able to save about $6,000 either towards a car, and also because she decided that when she goes to college, she might not need a car like her sister. Her sister would be like, I don't want a car, it'd be stupid. They having a car in college is paying money to have the thing sit there and never use it. Depends where you go to school. So if she might want to wait until she goes to college now. So we'll see. But meanwhile, Uber is perfectly fine. You know, she just uses Uber wherever she has to go, or she borrows mom's car, or she takes her bike if when the weather's nicer anyway. So we will see. But so far, it's working out. It's not bothering her too much. But it's a very mature decision. I'm proud of her. Anyhow, so what were we looking for? Yeah, this concerns me too. Lots of money went into cash. Lots and lots of money moved into cash, out of equities. People are worried about the trade war. So when this goes away, though, you can say, well, that's going to have a very positive effect on the market. When trade war goes to zero, then we're only worried about the China slowdown. But the trade war is kind of connected to the China slowdown, so both of those can go away at once. That's why I can't not be bullish in long-term portfolios, or we're generally still bullish. Because even though there's a lot of risks, these two major risks are going to go away quickly. All right, and then if those are fixed and we don't have a shutdown, people are going to be less worried about politics. So imagine knocking off 3 of the top 4 concerns in one shot. All right, the Fed has already talked about that they're not really going to tighten very quickly. That's one off the debt. Brexit, nobody really cares apparently, but it's a very low concern for people. It's probably an American survey, but it's a low concern here, and obviously that's going to get resolved at some point. So you know, and this is what I meant by these self-inflicted wounds. Most of the stuff on here is something we're doing to ourselves. These aren't risks that are not controllable. This is basically all caused by Trump. He caused the trade war. China's slowing down, not entirely because of the trade war, but China, the slowdown is more than China expected because of that. The corporate credit crunch is caused by the Fed's tightening. The politics are the same bullshit with Trump, and Brexit is bullshit that England's doing. So everything's bullshit. All these risks are bullshit. So there's no reason not to go long unless the world self-destructs. It might. And now Soros, you got to respect Soros. He's actually a brilliant trader. He's the Warren Buffett of Europe, basically. And he's vilified here by the Republicans, but the guy is a brilliant financial trader. He's run funds. He's made billions of dollars trading currencies. He single-handedly took down the euro at one point with his trading on purpose. Because he wanted to knock the currency out, and he made billions of dollars trading it down. But that's not what he's doing now. He's not trying to do this to make a profit, as far as we can tell. He's just saying, look, I know this. I understand this stuff better than almost anybody, and this is a freaking disaster. And the way they're doing this Brexit is going to be a disaster. And the whole system when England leaves, the money England complains about paying into the Eurozone, they'll stop paying. But the Eurozone still needs that money to function, because none of it goes back to England. That's the thing. It's money they used to run the European Union. The EU is its own government and has all this stuff. It's got another layer of government on top of everybody else's government that somebody's paying for. So you think you don't like our government? At least our government stops at the top. Your government, if you're in Germany, your government doesn't stop at the top. You're now paying for all the people in the EU as well, and that governing council and their programs and their stuff, which is very unlikely to proportionally affect where you live, especially if you're a big contributor like UK is. So if the UK steps out, and then France is going to probably tell them to drop dead, Italy's certainly going to tell them to drop dead. All of a sudden, everybody else has to make up that money, and now they're going to get pissed off. And so you start having defections from the Eurozone, and it will very quickly fall apart. Meanwhile, it would destabilize it'll be very destabilizing for the global markets for a while. But honestly, what does it matter? Who cares how Europe is run? Who cares if they're 20? Who cares if they're 30 countries or one country? It really isn't a big deal. Commerce-wise and such, it'll probably lower their overall GDP and so on and so forth, but it won't really change the world very much. But what it will do, though, is it'll in a negative way, it'll strengthen the dollar, because the euro collapses. Everybody's got to run to the dollar. There is no choice. There's no other possible currency that could absorb the amount of money that is currently in euros. It wouldn't even be close to possible for another currency to step up and do it. Not even China. They talk about China all the time, but China's yuan is not even, I think it's not even 2.5% of all the global currency. And you can't just print more. It's got to be in circulation. It's got to be naturally in circulation. If you just print more, you devalue it. So the yuan is only circulated, like 2.5% of all currency in circulation is a yuan. That's not enough. You can't possibly absorb the euro, which is 30% of all currency in circulation is euros. And the dollar is 60% of all currency in circulation. So, and the yen is 2.5%, and the pound is 2.5%. That means like everybody else is 2.5%. The entire rest of the world's currencies are 2.5%. There's not much left. But the dollar is close to 60% of all the world's currency. We would end up absorbing most of the euro's 30%, and the dollar would, and obviously, since again, same thing, we won't be printing more dollars, but the demand for dollars, the demand for euros becomes zero, demand for dollars goes up 50%. And that will cause a massive spike in dollar value, which will then devalue everything else, including equities. You can see the dollar at $1.10. You can see the dollar is currently at 97, 96, 97. You can see the dollar, if you consider that a percent of full, the 100 would be that full value for the dollar. If you have the euro move out, I don't think we go to 120, but we would be in the 110s. And then as the dollar goes up 15% its valuation, everything else, commodities will go down double that, stocks will go down at least 15%, because you buy them with dollars. So when you value it, if the dollar becomes more valuable, you're buying things with dollars, they become less valuable. So that's very, very, we'll deal with it if we have to, but that's going to be a major thing. Don't not be here if that happens, because we're going to have to make some incredibly fancy moves and stuff we're not used to doing, because now you're going to start learning how to watch the currency markets. Really not worth learning at all if it doesn't happen, but if it does happen, it'll be a great hands-on class. And I do not mean a one-day class. I mean, I'm talking like we're going to spend months like working on this crap. So if there's a one-day class, I'd give one now, but it's not like that. You've got to learn how to watch all kinds of crap. So we'll see. So I take that really seriously. There's a lot of people, unfortunately, in the U.S., uniquely in the U.S., they act like George Soros is some liberal dipshit, blah, 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 whatever. He's not. He's basically, he's no different than Warren Buffett, except he's got an accent and is more manipulative, and he's more acts in self-interest. Although he acts in self-interest, but then he gives away all the money. So, take it for what it's worth. His attitude is he's happy to take money away from from traders, from people who think they're geniuses in the financial market. He's happy to take all their money and then redistribute it to the poor. So in his mind, he's Robin Hood, and that's why That's why the conservatives hate him, because he literally does rob from the rich and gives to the poor. You know, he will trick markets into giving him tons of money. You know, but this is not that. That's the thing, and that's where it becomes where you have a bad message, because it's hard for him to have a serious message when people don't trust what he says. So when he says this, you know, people say, "Oh, he's trying to get us not to buy euros," but that's not what he's doing. I think he's really concerned. And speaking of devaluing money, the national debt is $22 trillion. Now, this is interesting because if the dollar gets stronger, then the dollar bonds become more desirable and the rate of interest gets lower. You know, if the dollar is going up 15%, people want to buy dollar bonds because the dollar appreciates in value. So who cares if you're getting a 2% rate of interest when the money goes up 5%? And my friend and I used to do this with Australian money all the time, because Australia used to go up and down like a yo-yo, and it was really fun to play. So, you know, you can play the bond market with the currency market as well. It's sort of a shadow way to play the currencies, because you're going to get your interest either way. So my friend lived in Australia, so his attitude was we could use his money to play the currency market in Australia, because he didn't care if he ended up holding Aussie dollars, because he needed them anyway. Like, he had a long-term need for Aussie dollars. So having his Aussie money in Aussie dollars, making Aussie interest, was fine with him, and they were paying 10% of the time with banks. But what we were doing is we would play the bond market, going in and out of it based on when we were timing it for when rates were low. Sorry, when the dollar was strong against the Aussie dollar, we would then buy a lot of Aussie bonds at 10%. But then we take the currency kick and cash them out. So when it went the other way and the Aussie dollar went up, we'd cash out the Aussie bonds, go back to holding Aussie dollars at no interest, obviously, it was just cash. And then we'd wait for the next cycle. But the rates were very steady, because the Aussie has their own central bank that was artificially maintaining the rate at about 10%. And the currency is what would fluctuate. But most people don't play that. Most bond traders don't play that. Most bond traders are just buying bonds. But there's a definite monetary component to buying bonds that people ignore. And it's a great way to take advantage of the market. Anyway, so our debt's 22 trillion. It would be good if the dollar got stronger from that perspective, but bad from a trade perspective. But that's not the worst thing. I mean, the whole, because Trump has made people freak out about trade numbers. Trade doesn't matter. It's not that big of a deal that you have a trade deficit, especially when you're a $22 trillion economy with a $500 billion trade deficit. It's not a big number. Okay, it means we buy a tiny bit more. We're buying 1% would be 2, so it's 2%. We're buying 2% more than from export than we were selling. It's not, we're not losing anything. It's we choose that, and we do choose that. By the way, we had that conversation before. We choose not to make iPhones with thousands of people working 14-hour shifts and having bleeding fingers from touching, constantly touching all the sharp pieces inside the thing, and jumping out of windows because they can't take it anymore, and sleeping in dormitories because the pay barely covers the cost of the food that they eat. We choose not to have that in this country. In China, it's considered a good job, but we choose not to have it in this country. We chose to take these crappy, people talk about great manufacturing jobs. They aren't great anymore. They were great once. They were great on Donald Trump's mind. They were great when he was a kid. He was like, oh, if you had a manufacturing job, you had a pension or retirement, blah, blah, blah. That's not true anymore. The pensions failed, the retirement's failed. There's no health care plan anymore, so it's not even a good job. Because the unions, some of them have good wages, but the unions are getting kicked out the door too. Manufacturing is often a shit job. And then the cost to the environment and the drain on the town's resources. And then God forbid these manufacturing plants close, half the town goes out of work in the same day. And the town gets destroyed. It's not the best system. So let other people have those jobs. what you need to do is develop jobs in this country that we'd like to have, instead of focusing on jobs that we no longer want. The reason we let them go to China and Japan and everywhere is because we didn't want them. Because we were choking on our own pollution, because we were almost at the point of having to walk around with face masks all day long. In the 60s, we had a movement to clean up the environment, and part of that movement was to say, you know what, why don't we manufacture things overseas? Then we don't have the freaking smokestacks going 24/7. People have no memory. They don't, it's like, people just remember like the good stuff and not the bad stuff or whatever. I don't know what the deal is. Anyway, so here's the problem though. We have $22 trillion in debt. Even if we're borrowing at 3%, that's $600 billion a year in interest on the debt. So half of our budget deficit is interest on the debt. And that makes it very hard for us to cut the deficit when half of it is just paying interest payments. Now, if interest payments go to 4%, and normal interest is 5%. So if interest rates go to 4%, now we got to pay $800 billion a year in interest. And at 5%, we're paying over $1 trillion just in interest on the debt we already have. And how are you going to knock that down? So that's one thing. Now, China is in the same boat. They got about $10 trillion in debt, and they're in the same boat, same problem, but they have a smaller economy. It affects them just the same as it affects us. Japan, way worse. Japan is a $5 trillion economy with $10 trillion in debt. China is a $10 trillion economy with $10 trillion in debt. Japan is a $5 trillion economy with $12 trillion in debt. Or actually no, probably. Yeah, that's about right. About 12 trillion, about 12, probably closer to $13 trillion in debt. That's insane. That would be as if we had $50 trillion in debt, and 2% was $1 trillion more every year. That, put that in perspective. That would be like us having 50 trillion in debt, and next year our interest on the debt, even at 3%, would be 1.5 trillion more dollars. You're dead. You know you're dead. You're just a walking dead man economy. That's what Japan is. Everything they do, everything Japan has done and is doing is just a game of the kind of game that a person who's bankrupt plays. And you know how people are bankrupt with these, like, borrow on credit cards? They don't give a shit anymore. It's like they know they're going to be bankrupt. They know they're going to bankruptcy court. So they just buy stuff, and they just keep buying things until somebody makes them stop. Because what's the point? It's going to be 7 years before you're allowed to buy anything again. You're basically going to have all the credit cards are going to get taken away. You're going to cut up all your credit, blah, blah, blah. Whatever you'll get left. And that's what the lawyer tells you, too. He's like, you're going to be left with whatever you have. So people going bankrupt very often end up buying a lot of stuff, hoping that won't get taken away by the bankruptcy court. They usually let you keep your home, you keep your furniture, you keep your basics, you keep your car for work. So a lot of people going bankrupt go out and buy a really nice car, and then because that way, if you're going to only have one car, you're going to get a nice car, and that's the one you're going to have to take to work. Trump knows that because he goes bankrupt all the time. So, and again, I'm not saying bankruptcy is a party because it's the penalties are severe, but a lot of people, I guess it's a scam. I guess it's not right. You shouldn't, ethically, you shouldn't run up your credit card to the max because you're going to be going to bankruptcy court and you're going to have to knock down your debts. And do workouts on everything. You should not pay you shouldn't avoid paying your mortgage while you're going bankrupt. Some people don't pay their mortgage for 2 years while they're going into bankruptcy because what's the point? You're going to renegotiate it with the bank. So why pay the money? So that's where Japan is. Japan is like that. They're just, like, who cares? Who can we borrow another $1 trillion here and $1 trillion? It's like, what's the freaking difference at this point? We're never going to be able to pay it back. There's no possible chance in hell Japan can pay off their debt. And honestly, there's no chance in hell we can pay off our debt either. $22 trillion. We would have to have a $1 trillion surplus for 20 years to pay that debt down. Okay? Right now, we have a $1 trillion deficit. So government spending is about $4 trillion, including a $1 trillion deficit, and we collect $300 billion in taxes. So, I'm sorry, $300 billion, $3 trillion. We collect $3 trillion in taxes, and we're running a $1 trillion deficit. So, how would you fix it? You would have to fix it by everybody paying 30% more. No, 30% more would just balance the budget. 60% more taxes, 60% more taxes is what you would need to pay off the debt in 20 years. If we don't pay off the debt in 20 years, at any point during those 20 years, if interest rates go up to 10%, we will add $2 trillion a year to the deficit for that period of time, at which point it'll wipe out any kind of gains we would have made from all the sacrifices we've made at that point. So we could do all that sacrificing, although it's really impossible. You can't afford 50% more taxes. But even if you were paying 50% more taxes, it's still going to take 20 years to pay down the deficit. And if any crisis happens in those 20 years, the deficit can pop right back up. And like in 5 years from now, if there's a problem that costs a few $1 trillion, like the last financial crisis, you've done nothing. You've paid all that money, and now there's just as much debt as there was before, and rates kick up to 10%. Now we're adding $2 trillion a year to the deficit, and now the government needs 110% of what you earn just to stay even. That's where we are. Everybody needs to grow up and look at this. This is where we are. You can't grow your way out of it. It's a fantasy. There are ways to fix it. You have to do radical stuff like the Democrats are proposing, like Cortez is proposing, like Warren is proposing, but they are being shredded by the mainstream media and which is owned by billionaires. So of course they're being shredded by those guys. None of those people want this. None of the people who own these broadcasting companies want this to happen. The only solution is to have the people who have the money. And the top 1% of the country owns 40% of this country's wealth. The wealth of this country is $100 trillion roughly. The total wealth of America, of all the homes and all the assets and all the stocks and all the stuff, is about $100 trillion. 40 trillion of that belongs to 1% of the people. If we took half their money, we could pay the national debt off. If we confiscated half the money from the top 1% of the people, we could pay off the debt and nobody else would be bothered by it. All right, now a lot of us, I'm in the top 1%. I would not like half of my money taken. That would annoy me. But I think to avoid that, I wouldn't mind if somebody said we're going to take 20% of your money, as long as they were taking 20% from everybody, and we knocked the debt down considerably by like $8 trillion, and we put in some plans in place to make sure that we pay it down in the future. If we had a realistic plan to start paying it off and it required me to sacrifice 20% of my stuff, I would say, okay, I'm willing to kick in that. But we're not doing that because we're not having rational conversations about how to deal with this stuff. And because we refuse to deal with it, and because we refuse to have rational conversations, it gets worse and worse and worse and worse. And it's basically already out of control. In 8 more years, it's going to be completely out of control. It'll be at least $30 trillion in 8 years. We don't do something now, just like climate change. We don't do something now, it's going to get worse and worse and worse. So I don't know. So what's the solution? So there's 2 solutions. The solution number 1, what's the solution if you refuse to be responsible? Solution number 1 is is default, which completely collapses the world economy. Default doesn't help rich people either. Rich people are the ones that hold the bonds. Not a lot of poor people have bonds. Your pension plan might, but it's not a lot of companies have bonds. A lot of companies have a lot of their money in bonds. If we defaulted, we would collapse the bond market and collapse a lot of stuff. We would collapse the entire economy of countries that have lent us money, which includes China, frankly, but they default too, so what's the difference? So we could all default and reset the table at zero, and there'll be incredible wipeouts and horrifying things would happen. Or we could have hyperinflation. If we have hyperinflation, that would grow the economy. So let's say we have 15% inflation. That means our $20 trillion GDP would grow to be $23 trillion and $26 trillion and $30 trillion. And it would, now the trick is that it would hopefully grow faster if we grew the GDP but didn't borrow more money. So if we freeze government spending at $4 trillion, and yes, you have to cut that because things would get more expensive, we'd be spending the same. But if you freeze government spending and pay and grow your economy, suddenly becomes a small percentage of your GDP, and also all that wealth that we have now, the $100 trillion or $40 trillion that the top 1% has, would become $80 trillion. And then taking 20% of that would give you a much bigger chunk to pay off the debt. It would give you $16 trillion to pay off the $22 trillion debt. So yes, if you can increase everybody's wealth by 100% while keeping the debt more or less in check, it becomes something you can deal with. Like we should have dealt with when it was half as big anyway, relative to GDP. So those are the solutions, either hyperinflation or default. There's really no other solution, because the other solution, obviously, the sensible solution is, okay, wealth confiscation. The rational solutions without going crazy with hyperinflation or default is wealth confiscation. Have to do it. Have to tax the shit out of the people who can afford it. Oh wait, I lost you. Okay, wait a second. So is wealth confiscation or sensibly, changing the budget and all that crap. That's just, it's just not going to happen. Like you can't make people pay 50% more taxes. We can't all pay 50% more taxes. It's just not possible. That would cause a massive recession and be detrimental anyway. So everybody can't pay 50% more tax, but you know who can pay 50% more tax? George Soros, Bill Gates, those guys, Jeff Bezos, all the corporations. By the way, when you talk about top 1%, you got to talk about corporations too, because they are the worst. Corporations last year, on $6 trillion in income, paid $300 billion in total taxes. That's a problem. That's a really, really big problem in our budget. That we effectively don't even tax corporations. There's so many ways they get out of pay. All right, and that's net though, because it's they don't show. See, that's the problem. They don't show $6 trillion in profit, because the ones that lose money are deducted from the total profits of corporations. But that's stupid, right? The ones that make money are the ones we want to tax. Because for every corporation, and you talk about corporations, it means anybody who's incorporated, even every little, all you need is little money-losing schemes and corporations and things like that never show a profit. Those count on the IRS when they talk about corporate profits. If you're in Inc., you've got corporate profits. So all the money made by corporations is $6 trillion, minus the money lost by corporations, $3 trillion. Gives them huge amounts of room to write off and whatever. And even the big corporations, they obviously write down all kinds of stuff thanks to our tax laws. And they're the ones that get tax breaks, which is amazing to me. So that's the problem. It used to be that corporations paid 60 to 70% of all the taxes. Now they pay 10% of all the taxes. And that really is why we have a deficit in the first place. The entire national debt is due to the lack of corporations paying taxes for 40 years since Reagan. Anyway, what was our topic before we went there? We were going to look at some stuff. Let me check questions though. Tom says, I was asking what math you used to pick 2720 as the bearish number. I was using the 200-day moving averages, and the other one was a 5% rule where we were calculating where the lines were and then how much of a move off that line. So basically every 20 points was like 1% of the move. I don't know exactly, but I really don't feel like going back to it, frankly, doing the whole thing again. Let's see. Oh, what's this? Portfolios. Oh, so this is a snapshot of the long-term portfolio, which is having a fantastic month. It is up 20%, almost 20% for the month. Wait, did I say where we were? I don't know if I did the math over here. No, about 200,000. It was too big of a number to worry about. So, oh, that's right, we did though. Right after we did the last review, we crossed the $1 million mark, and now we're at $1.18 million. So basically 18% up in a month. It's crazy. I mean, of course, this portfolio is 100% bullish. There's no bearish positions in this portfolio. And the market has snapped up and just given us a huge gift at the moment. And frankly, it's still going on. We didn't have that bad of a pullback today. It was not even a pullback, really. I mean, we topped out. Now we pulled back from that, but we're still positive for the day. So this is how you make a fortune in the market. I mean, it was basically, we had very few changes from last month, but the positions have all come back nicely. And we talked about that last week. It's like when things are down, we improve the positions. We take, we were in $140 Apple calls, wherever that is. We were in the 140s and we rolled down, or we were in the 160s. We rolled to the 140s and then it went lower. And we said, okay, fine, we'll roll to the 120s. I don't give a shit. So, we made $87,000 off the 120s. But we also, on the way down, lost plenty of money on Apple. So it's not all profit, but it doesn't really matter, okay? It's profit from that day. So the long-term portfolio took a hit and was down quite a bit, but it came back incredibly nicely. But why did it come back? Because we moved our positions. We originally had 160 calls. They wouldn't look very exciting right now. But the 120 calls are super exciting. They gained 58%. The 160s are just about even from where we started. We put more money into work at the lows, and that got us rewarded. That's why we made this huge money. I mean, there's half our gains right there. It's just from that. That's why we make so much money, is because we push these positions. Okay, when something we like goes lower, we buy more of it. Chipotle, same thing. We push those down from our originals. We're getting killed on Chipotle though. Well, not really. These 540s, of course. So these are plus 187 minus 161. This is what I talked about earlier. I said you've got to understand how options work. I don't care about 187, 161. What I care about is this spread is $60 times 20 units is $120,000 spread. That's the value of this spread if we're in the money. Currently, it's at 94, 67, 71. So currently it's at 71,000. The fact, see how you're up 187, down 161, so it's plus 18. So not plus 18, plus 26. So it's plus 26 overall in profit. It's showing a net of 71,000. That's showing a $26,000 profit. Our original was right about 50,000. That makes sense. But what matters is this is a $120,000 spread that's currently worth $70,000. And if Chipotle holds 540, we're going to make $50,000 more. So that then puts this in context. We've lost 45,000 on these calls, but again, they are the 550 calls. We're only at 600. 12 times 50 is $60,000. They're currently running at $64,000. So at 600, these are overpriced a little bit, and this will wear out some of this premium. Also, if we stay at 600, we know we're going to get $50,000 more dollars. So if we leave this as it is, this will gain 50,000 more, and these will stay flat. So this position can add 50,000 net dollars. That's how we look at the position. So a lot of people look at these things, they panic out of it and stuff. Also, we're going to obviously roll these. These are March. So the March 550s are $53. PNG. So the March 550 calls are $54, let's say, and we're going to roll them to, let's say, June. What's $50 in June? The 580s. Oh, that's not so bad. Still, I'd like to go higher. I think I might feel better about it. So let's see what September looks like. In September, look at that, 610s. Ah, that's good. So depending on how we feel about Chipotle, if they're still below 600, I'll probably go to the 580s because I think they will pull back eventually. But if they're above 600, at least I know I can roll to the 610s, and that means that the short calls will be all premium again. Also knowing that my net $70,000 main spread, my longs. Well, no, that's not Chipotle. There it is. My longs will, this 70,000 longs will become 120,000. Will gain 50,000. I also know that if I double down on these, because they're in the money, they're $60 in the money. If I double down on these and put another 70,000 here, then I'm going to gain $100,000 if it holds 540, and I can roll these to more than 12. Because I'll have 40 longs. I'm going to make 100,000 here if it stays positive, and then I can roll these along to maybe 20 shorts. Because I'll have 40 longs. So you got to think ahead and think, how much can I really make out of this position? How much is this position costing me? What will I do on my next move if it doesn't calm down? So if Chipotle isn't closer to 550 in March, so the 575, these go to 25, and we make $30-something thousand just from that, and these are still in the money. So I'm not worried about this position right now, even though that's very painful. When you look at it, it says 187 minus 161, so minus 200, I'm actually net minus 13,000 on this spread. It would be depressing if that was all you looked at. But I look at this spread, I'm like, holy crap, I can easily roll this to the 610s. And these guys are going to make me $50,000 more dollars. I couldn't be happier with this position. Okay, yet people who don't understand options would close this position and say it's a loser. I want to close it before I lose more than $13,000. That's already a big loss. I don't want to lose more than $13,000. I'm like, this isn't a $13,000 loser. You're going to make 50 here, plus you're going to get this money back. This is a $100,000 winner, and you'll throw it away because it's minus 13,000. That's why you've got to understand how options work. You have to understand the relationships between the money. You have to understand what your strategy is. You have to understand how much you're going to make from the position and how much and what adjustments you'll have to make and whether or not they're going to be reasonable adjustments. So I already have a plan, and if that plan fails, I have another plan, and if that fails, I have a backup plan to that. I'm very comfortable with those plans. I don't think Chipotle is going to go to 660, 670, and if it does, I'm going to double down. I'm going to easily make another 100,000. I'll make easily another 50,000 here. That 50,000 is going to pay for another $100 loss on this side, or $50 loss on this side anyway. So 10%. So if it goes up 10%, I double down here, make 50,000 more. That 50,000 more pays for another 10% loss over here. And if I have to buy more, if I have to keep paying $70,000 to make $120,000, I'll keep doing that. Yeah, I think I will. That doesn't, it just doesn't sound that awful as a punishment, right? It's like, well, the trade's not going your way, so you have to make another $50,000 to cover it. I'm like, okay. because I'm covering it by making the bet that the trade's going to keep not going my way. If it does go my way, I'm going to make all the money I lost on here back, and that's more than $50,000. They get you to a point where you really, they hurt you, but it gets to a point where they really can't hurt you anymore. It's not going to get worse, and you have to recognize that. These are a little more blurry. I have to cut this. If I put too many longs, it kind of makes it a fuzzy thing to read, unfortunately. Whirlpool, I'm considering for a butterfly play. Actually, they might work out. I think I had a reason I didn't do it. I think it was disappointing short sales, maybe, because I like them. Look at that. That's 127. That's 20%. It's not good, but it's over a couple of months. But it's a nice channel. Longer term, it's generally a nice channel, especially now they're getting back here. I expect them to be pretty consistent around here. Then we're going to get this kind of movement for the next couple of years in Whirlpool. So that kind of makes them interesting as a bullish butterfly I would do on them. And WHR, nope, spell it correctly. So Whirlpool, the March, we're 138. So let's say we do 145 now. That's terrible. See, that's the problem. So next month. Ooh, it goes right to June. So let's say we do June 145. Let's see, that's not bad. The June 145s, which is only 128 days. Well, only, it's a lot of days, but out of 700 that you would have, so 128 is, let's say it's 1/5. So out of 20%, so one out of 5 sales, you sell the 145s for $550, and you sell the 125s for $455, whatever. So you're gonna get at least $10 here. So now I know I'm gonna get $10 5 times. I can get $50 selling some pretty good premium, pretty far out of the money premium. What could I do for a long? Can I get a cheap long? Again, margin issues, but let's see. But you see here, the spreads are way more reasonable. So the 137, if I want to cover, I'm generally bullish. So I want to be bullish. I start off here and say that's $22.50. $10 lower is $27.50. So that's $5 for that. I would pay that. $10 lower, so we're calling that $27.50. This is going to be more than $32.50, so I'm not going to do that. So we're going to start here at the 125s, and how much are the next ones? $27.50. These guys would have to be $30. $30, the 120s. And I would take the 120s for 30. And I prefer to pay, obviously, less than $10, because that's how much I'm going to collect each time. And I'm not going to do a full sale, though. So if these are 30, I want to sell something that's about 20, but that's the 140s. It's too low. The 160s are 16. I can deal with that. 14. I don't need that wide of a spread. I think the 120, 150 spread. Oh, we could do this. So if we can do the 120 for 30 and the 150 for 16, that would be $14 for the spread. We could offset that by selling these guys for 8, the $100 puts for 8. So let's say we sell, did I do that right? Whirlpool, okay, it worked, okay. So we sell this at 8, but we're only gonna sell 5. And that's gonna put in, there you go, 5. See how much better that is than the other one? The other one's 16,000. This is gonna be $5,000, and we're gonna get so much more money for this. So I'm gonna set this up for the butterfly, it's a good one. So we only have $5,000 knocked off our buying power. That's totally reasonable. So we then put that money back to work over here. We're going to take the 120, 10 of these. We're going to take twice as many as we're selling puts. So we're going to take 10 of the 120. 150 spreads for 14, so that's $14,000 less 4,000 collected here. So for $10,000, we're going to be in the spread. And how much can we sell? We said in June, we can sell the 145 calls for 550 or more, and we can sell the I'm bullish enough to sell these. I would sell the 125 puts for 450, 475-ish or whatever it is. So that was 550. So it's at least $10. So if we sell half as many as we bought the longs, then we're going to sell $5,000 worth against our position that's only $10,000, and we have 5 more times to do that. But not only that, though, but this is not a neutral position, it's a bullish position. So if we're already $15 in the money on our longs, $15,000 in the money on the longs. So we're paying $10,000 for a spread that's $15,000 in the money, with $15,000 more dollars to gain if we get over $150. And while we're waiting, we're collecting $5,000 a quarter. Yeah, $5,000 a quarter, selling puts and calls. That's a long trade. That's the kind of play we want in the butterfly portfolio. That's a trade that can make you $25,000 plus another $45,000. So you make $45,000 back on your $10,000, and it's a very reasonable spread because it would have to go in the short term. It would have to go more than 10% down, or more than, or not more than 10% up, but about 10% up. Yeah, you would have to go 10% up or down to hurt you, and then you can roll out another 10%, and we think that it's going to stay in a 20% band. Because watch, if the next thing that's $5 is way up here, 155s, and the next thing that's $4 down here is the 115s. So you can keep rolling. Whichever side loses, you just roll it further out of the money. And once we collect two, once we have 2 winners, so if we get in the middle of the puts and the calls and we collect on both ends and cash it out, once that happens twice, the whole spread is free. It's a $30,000 spread, and it's free once we clear 2 sales. That is a butterfly portfolio play. Somebody remind me of that later. Definitely doing that. All right. Anyway, so you see how these reviews are great to do? All right. Tiva. Oh, we knew about Tiva. Yeah. See, back in October, we used to like Tiva because I used to like Tiva. See, it's context though, because it's like people remember like, oh, don't you like Tiva? I like Tiva, but I liked Tiva when it was like $10, and I was like, that's stupid. Company doesn't have to be good for me to like it when it's like for some ridiculously low price. But now, after owning them and getting out of them when they were up in the 20s, because I said that was stupid too, just because they came back to 18 or 20 didn't make them attractive. And I said to Lerner at the time, and he likes Tiva because he asked me again 2 months later. I said we liked them before. We thought the positives in the pipeline, the changes in the health policy and regulation outweighed the negatives. I'm not sure if that's still the case, so I wouldn't knee-jerk buy right here at 20. I wouldn't knee-jerk buy because they are back at 20. Coaxapone is a drug that they are losing their exclusive on. You have to know your companies. This is why TA people can't make money, and they always go, why can't I make money? If the squiggly line looked like it was going down and then it went up, it's so what's wrong with the market? It's like you got to know what the company does. They have a huge drug that they're no longer going to have an exclusive on. It's going to start eating into their profit, and it's going to keep pressure on them for ages. It's going to get worse and worse and worse as more and more competitors come on, and more their doctors like, okay, it's like Viagra. Everybody was prescribing Viagra for a while. It's huge mega drug, whatever, right? Then Cialis comes along, this other one comes along, this other one comes along. So for years, Viagra has this exclusive market. Then they go off patent, and other people start making something similar. Now, at first, the doctors don't prescribe it. They keep prescribing Viagra, but then the pressure comes from the healthcare companies and everyone else to lower the cost of these things because they don't like paying for old people to have erections. So they they get the doctors to prescribe things that are cheaper and have lower dosages and so on and so forth. And the doctors will bend to that kind of pressure, especially if the rep takes them out to lunch or something like that from the pharmacy company, or sends them on a cruise so they can learn about it. I love these educational cruises. It's such a scam. If they go on a cruise where the doctor goes like they don't have to go. They just have to there's lectures on the boat about these drugs, and they take the cruise and they basically just hang out on the boat and have a good time. So Coaxphone is off patent. It takes a while to erode the base, but over time it does erode. The salespeople get to the doctors, and all of a sudden you get less and less market and whatever. It takes time. That's why people don't think it's a big deal at first, but it is. Although sometimes people overreact because they act like they're going to lose their market share tomorrow, and they're not. We played Gilead that way once because people act like as soon as something's off patent, they're going to lose all their market share. It's like, no, it takes ages for people to switch. The people who are taking it now are going to keep taking it until someone convinces them not to. It's not that fast to switch everybody over from something. So if you have, that's why it's nice to have that 5-year patent, because you get a long time to build a base, and that base is going to be hard to shake, but eventually it will shake. Eventually, price usually wins out. So anyway, so 2020 on Tiva is 20 billion. This is their best year, and they made 3 billion. Last year they lost no whatever. They're inconsistent anyway. So it's like, so what if they made 3 billion this year? They lost 16 billion last year. You got to look at that too. You can't just look at what they're making now. How often do they make it? How consistent are they in their earnings? Then he asked again. On 12/10, because they fell further. It was a good question, because now it's 20% lower than when I told them I didn't like it. So he said, how about now? And I said, they were 11 last November, so 18 isn't much of a bargain. It was 18 only. They lost 18 billion last year. Oh, somehow went from 16 to 18 billion. This year looks break even. So in other words, they were. I wasn't even paying attention because if I didn't realize what I said before. We thought they were going to make $1 billion. They didn't make $1 billion. They ended up breaking even this year. That's not exciting. So they got worse in between the 2 months that we talked about it. On the plus side, they've written off a ton of dead-end drugs, but on the bottom side, they have a portfolio of aging drugs that are facing declining sales, stiff competition in a price pressure environment. On the whole, I said, I want to see clear evidence that they're going to make money. They've got to make $300 million a quarter to convince me that I should be buying the stock for $18 billion. If I'm buying the stock for $18 billion, I want it to make $300 million in a quarter. They haven't made $300 million in any quarter. Here's AR we were talking about. And again, it's the same kind of thing. They had a good number here that makes them look like they're good because they're a $3 billion company. They made $600 million. It's like, holy shit. But if you look at here, I can show you here. You can't assume anything is real. You got to confirm everything. Otherwise, you're just, you take the word of one thing, even something you rely on, you have to assume that it might not be right. So AR is Internal Resources, and last year they showed a $785 million profit. Wait, what? Anyway, they had a $300 million tax credit though. So they only made $490 million, and the rest was a tax credit, and that's how they made $785, or $615 now. How does it net out to $615? That's weird. Way to go. Whatever. I don't get that. But half the money they made was a tax credit, and the year before, half the money they made, even though they lost money, was a tax credit. So how many tax credits? That's probably it for their tax credits, right? They probably used them all up. So that means they're not going to do that again. So when you look at these projections, the analysts, unfortunately, are lazy bastards, and most of them don't know what the hell they're doing. Where did that go? Disclosure? No. Oh, it was on here. That's why I didn't have that. I don't have that thing up for looking them up. So we know that half of this money was tax credit, and they're extrapolating through that they're going to make this money, but they'll have to pay taxes. unless things get significantly better, and there's no evidence of it, because if you go back again, and I know this stuff is kind of boring, but that's my job, unfortunately. It's not exciting. I go back here, look at the quarterlies. Are they really doing what they say they're going to do? Yeah, they're going to look like they're going to hit $4 billion in revenue, but they're not making any money at it. 80, minus 80, minus 60, they're negative 60 at the moment. Don't tell me they're going to suddenly come up with 300 million. They didn't do that last quarter. Last quarter, they made 129 in the fourth quarter, and they got a $400 million tax break. And that's where this moron is coming up with 337. Whoever ran this sheet extrapolated it and assumes that the fourth quarter of this year will be the same as the fourth quarter of last year. But last year was because of a tax break, not because they have great fourth quarters. But that's the problem, because the person who's following this company, which is an E&P company, oil exploration, the person following this company probably doesn't know the difference between an E&P company and a fucking retail store. And probably goes, oh, well, Christmas is a big quarter for them. That's probably normal. It's got a completely ridiculous concept. They're probably not going to make anything like that kind of money this year. And people who follow these analysts are going to be shocked and say, oh, how could that be? But that's why this number is probably from a forward projection the person read that made this sheet. This line is probably, and by the way, this is a very respectable service. I forget the name of it now. Stockopedia. Yeah, it's something by Stockopedia. Oh, is it? Hang on. Investopedia, sorry, Investopedia. No, Stockopedia. All right. Yeah, it's Stockopedia at its called. I think this is called Stockopedia. All right. I thought there's some name for the thing that they have here. But anyway, so in Stockopedia, which you have to subscribe to, they're generally very, very good. But that doesn't mean they're not the analysts. It's not their job. This is what the analysts say. But I'm saying that one lazy analyst or a group of lazy analysts, it doesn't really matter. Oh, and that's another thing, by the way. Sometimes I'll look at that and I'll say, well, how on earth did they get this number? And then you look to see, well, how many analysts are actually following this stock? So analyst price target 16. It seems like 16 people might be following this thing. Is this going to tell me anything? Number, yes. Okay, so they have 16 analysts. Would you think that 16 analysts would come up with a better number than that? But you know, being a stock analyst is something that if you go to school and you have an accounting or finance degree and you go to apply at Goldman Sachs and they don't think you've got the balls to be a trader, and especially if it's like a nepotism kind of job where they're hiring you as a favor for a friend or something like that, if they don't think you have the balls to be a trader, which they take very seriously, they say, hey, how about being an analyst? we can use you at this desk. Go sit down there and be an analyst. And now some analysts learn that, become good and learn their trade and become things. But most analysts, and you see this from tip ranks, there's a thing called tip ranks. So if you want to look at who these analysts are, then you go to tip ranks. And they give you a rating on these analysts. So when you're reading something, I strongly suggest that you go to tip ranks and you look at who these people are and whether or not they even have any idea what they're doing. So they'll tell you, they'll tell you whether these guys make good recommendations, bad recommendations, so on and so forth. So if we say Adam Shine, okay, just as an example, is the first guy that came up, not to pick on Adam, but Adam Shine is the analyst at the National Bank. And Adam Shine's coverage, blah, blah, blah. His success rate is 66%. That's quite nice. His average return is 7.4%. 67%, 58% of his ratings are buys. He only has 7.5% sells. He doesn't generally issue a sell. So you learn this about people. And it kind of gives you an idea of what makes up these things. Because sometimes you'll see people who have like 25% accuracy, and you're like, everybody, if you're any kind of analyst, you got to be at least 60%. Otherwise, what are you doing? It's a coin flip below 60%. So you can't follow these people blindly. They don't know what they're doing, most of them. Most of them don't know what they're doing. There are guys who are good, and I picked them off the front page where they were showing you the guys who were good. I don't want to be mean to anybody. I mean, there are plenty of people who aren't good anyway. Let's see. All right, I'll tell you. Here's a good one. Let's go to Tesla. Just to show you something. TSLA. Here's Tesla. Here's the analyst. Look at the ratings on these analysts. 1, 2, 3, 4, 5, 6, 7, barely 8. 8 analysts out of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So 8 out of 13, I think it was 13, are, there's more. So 8 out of 13 that I'm seeing here anyway. Oh, I see, we're not seeing the top one. We're not seeing everybody. But 8 analysts have 4 stars, and 5 of them have less. Some of these are 1-star analysts. 1 star. Look at this poor bastard. You are better off flipping a coin. Okay? You are better off flipping a coin. You are better off. No, he's as good as a coin. This guy's as good as a coin. Goldman Sachs analyst. These are supposed to be the best of the best. These are the guys, these are the people assigned to follow a major company. Oh, look at this guy, 29%. This guy, you should follow whatever he says, do the opposite. You will be 71% successful doing the opposite. Your return will be phenomenal because you will be doing the opposite of what this guy says. He's the Deutsche Bank, that figures, right? Because Deutsche Bank's a disaster. You've got to know who's telling you things. Just because it says Goldman Sachs doesn't mean the guy knows what he's talking about. John Murphy, what does John Murphy say? Again, coin flip. All right, who's the top guy? Ravinda Gill, whoever that is. He says sell. 56%, coin flip. Brian Brinkman also says sell. Oh, 62%. He's a superstar. I mean, it's such a freaking joke. %, another superstar. See, there's some really good guys here. So here's another 5-star. Who's that? A 5-star hold. Oh, I like that. Great. Oh, 59%. Very good. So hold. What happens if you say hold and it goes up or down? Are you right or are you wrong? I don't know. Anyway, so it's very easy to check out analysts, but very few people do it, and very few people. The big problem is, please don't assume an analyst knows what you're doing, okay? An analyst is my daughter's friend, okay, who's getting stoned on a couch in college now, and 5 years from now, he's going to be wearing a JP Morgan hat, and he'll be commenting on the situation in the markets when he doesn't know crap. Okay, he'll be assigned to cover the agricultural sector when he's never stepped foot on. The kid from Boston's never stepped foot on a farm. How do you cover things you don't know about? I had that conversation with Mutha Kent, the CEO of Coca-Cola, because I interviewed him, and I in depth looked into the company. I went to Atlanta, and it's like. I've done that before, consulting with beverage companies before. I knew the industry. He liked me. He liked me a lot. As I said, he retired actually because it was fun. But he loved talking to me because I understood his business, and I understood his business because I got the experience to do it. I was the right guy to talk to him. and I'm the right guy to analyze his company. So I picked things, and that's the thing. I'd ask him about stuff that he was like, "Whoa, how do you know about that?" You've got to know what you know and know what you don't know. And if you're going to rely on somebody, you have to know if they know what they're talking about. Okay, what other companies does here? Who's got a buy on Tesla? Colin Rush. So he's from Oppenheimer. He's a coin flip. What else does Colin run? Now he's got to be a complete expert on cars, right? But he's not. He's a solar guy. He's an energy guy. He does Nextra, Polyome, Cree, Canadian Solar, Bloom Energy, Amber Semiconductor. He doesn't know shit about cars, and he's telling you to buy a car company. This man has never covered a car company before. I would take that with a huge grain of salt. Even if he did, he's only right half the time anyway. All right, enough of that. It pisses me off, and I really do. You got to understand. So when I look at these things, because I get it all the time in chat, and I don't mind. I understand where it is, but you guys have to understand why I get frustrated sometimes. You're like, oh, this guy says that. What do you think about this guy's opinion? I'm like, that guy's a moron. Just because it's in writing, just because it's in the paper, just because it came from Goldman Sachs doesn't mean the person who wrote it knows what they're talking about. And by the way, Goldman Sachs purposely hires people who are idiots to write idiotic opinions because they want to put out false information. They want the Goldman Sachs analyst to tell you to sell something. When a fund wants to influence the price of something, they need to get a bad recommendation out there. They need to have somebody savage a company. They ask a dozen analysts to put reports in on the company. There's a thing called a Chinese wall. They can't tell them to write a bad report. That would be a major crime. But what they can do is have a dozen analysts and ask a dozen analysts to write a report, and whoever writes the worst report on the company, the most scathing takedown of their business, that's the one they will reward and put him in and use him for their and then put him down as a Goldman Sachs analyst on that stock, because they want a negative opinion on that stock, either because they're punishing somebody at the company because they didn't go with Goldman Sachs, or because they want to get their big money people want to come in and buy it, and they're trying to knock down the price. So and again, the Chinese wall protects them, because just because their analyst said not to buy something doesn't mean that their senior advisors can't say, you know what, I think we should be buying the stock anyway. And the big money guys, you know the game. If you're a top 1% investor and you're tight with your broker and you talk about insider stuff on a regular basis, then you know this. You know that's how it works. Because the guy, your guy, your wealth manager, as opposed to your broker, we have wealth managers, and your wealth manager will tell you, oh, he's a schmuck. Don't bother about him. don't buy that. They know. None of this, it's a big, giant freaking game. That's what it is. Don't take it too seriously. Anyway, so the net thing on AR was no, it's just not that attractive. Oil. Oh, also, then I said, even if all that was fine, even if you believed in all this stuff and thought they were worth, even if they were going to make $300 million and it was going to be, hopefully keep making it, but they're not. I said, look at this. Last year, oil was, wait, no, not here, sorry. So look at this. Last year, oil was $65. This year, oil's $55. They didn't make any money at 65. Their expenses don't change, and now they're getting less money for the oil. They're going to get their asses kicked this quarter. So again, a reason not to buy something. You've got to think of how the business actually operates. How do these guys make money? They sell oil. That's how they make money. So if they sell oil, I should probably look at the price of oil to see if they're making any money. Oh, I forgot. There's a really good opportunity on ABX. All right, let's see. Coffee. I said coffee I want to buy, and it's actually a little bit lower now, but it's down around here is a great place to buy coffee. I think I said that. The KCN 19 is July. This was that money to our portfolio. Also, the untouched money to our portfolio gained $12,000, which is, and it's a $50,000 portfolio. So that's, I don't know, a lot, 24%. Gained 24% in a month, in 2 weeks. This is crazy stuff. I mean, these are good picks. Barrick Gold, Gold, Barrick Gold. They sold off today, not much actually. Their earnings report showed what freaked people out in their earnings report, and it probably seems to have gotten better already, is that the cost of production went up significantly, GOLD. But that's because ABX, the original ABX, bought gold, which I forget was Reinhardt Gold or somebody, whoever the hell they were. They bought ABX used to be Barrick Gold, used to be ABX. They bought the company whose symbol was gold. I think it was Reinhardt Gold. Anyway, the reason that ABX's production costs went up, or gold's production costs went up, is because now it's a combined of them who were the lowest cost producer of gold in the market. They bought a company that had a higher production cost than they did. So now the average cost has gone higher, and that is scaring investors, and that's why it went from 1340 to 1280. And I forgot, because this morning I was going to say buy this because it was stupid, because you're panicking about what's an average. In other words, if Barrick Gold last year had a $750 cost of production, and GOLD had an $850 cost of production, and they have about the same production, then now their average cost of production is $800 because they combine the company. And people are looking at that, and what they're doing is they're taking only Barrick's $750 and comparing that to $800 and saying, oh my God, your production costs are climbing like crazy. No, what's going to happen is they're going to do what they always do. They do this all the time. They buy a bunch of mines from somebody in bulk, and they get rid of all the ones. They're very good at making the production costs lower, but any one that they can't bring down to their preferred production cost, which is around $750, they will then sell that mine to somebody else, and that will then take away the negative and create a lower production cost for the company. Because there are plenty of people who are thrilled to mine at $850 because you can sell gold for $1,300. That's fine. But Barrick wants to always be the lowest cost producer. That's their goal in life. So they will buy, if they buy 20 mines, they might keep 6 out of the 20 in the end, and they'll spin off the rest to other companies because they just don't want it. They're like, I only want the 750 mines. Because if gold crashes and goes to 950, I can still sell gold, and you guys are screwed. So that's their entire business strategy long term. So in no way, shape, or form do I consider this a negative, but it took them down considerably and tossed their momentum. So they're great for a new play right now. And the play we have on ABX, wherever it is, it's not ABX, it's gold. This spread is now net negative, so you can play that as a new play. It's the 2020 10-15 bull call spread, which is right in the middle of it. So it's half in the money with the 17 short puts. Although actually I wouldn't do the, I'm sorry, from scratch I wouldn't do the 17 short puts. I would do like the 1250 short puts in 2021. But a great opportunity to get back into this thing before it goes much higher. Anyway, so that portfolio went way, way up. The oil inventories were high. As I said, I wanted to short it at 55, so he did hit 50. Oh no, I'm going to hit 55 today. But we're getting back towards 55 where I want to short. Natural gas, I like 4 long down here at 260. Probably the NGV, which is like October 19th. Oh, we made money on the Dow today. We made money because we picked a short very early on. Here's the butterfly portfolio. So now we're going to add, who did we just say? Somebody better remind me. Going to add somebody to the flight portfolio. I forget who the hell we were looking at. It was a good one though. Whirlpool. All right, one of you guys remind me in chat, please. It's very important. I want to do that. And here's our adjustments there. And I think that's it. And then it was webinar time. And all this news came in since then. And that brings us to now, which is 2:55. So we are going to end the webinar unless there's any more questions. I hope you all learned something. Well, let's see what happens. Somebody had a question. Vern says, Gold, what's your view on their earnings now? Yeah, that's my view. My view is that everything's fine. If you absorb a company the same size as your company and you make money at all, you're doing a good job, okay? It's like there's a lot of costs associated with a move like that. You've got to move offices around, you've got to pay people off and severances and so on and so forth, and all this stuff. So they're doing fine. Their revenues were a teeny tiny miss, and like I said, the production cost increase is nothing. It's only an average. It's caused by math. It's not caused by anything they're doing wrong. ABX, the old ABX, still has the same mines at the same cost, and the old GOLD has the same mines at the same cost, and the average of the two is higher than ABX's low. Obviously, that's how averages work. So it's just it's a stupid sell-off. Great opportunity to get back in, to get in at a lower price. Can you suggest UNG play on natural gas? No, I cannot, because you should not play UNG, because it's a terrible ETF that has a horrible rate of decay, and it's a horrible thing to play for the long term. So I would not play that. If I'm going to play natural gas, I would play CHK, Chesapeake Energy. They are a big natural gas driller. Unfortunately, they have a lot more oil than they used to. They used to be pretty much all natural gas. Now they've moved into a lot of oil, which is not helping them recently. But they're at a super duper low, really great price. We have them in the long-term portfolio. This is probably not even logged in. No. So if I can find the long-term portfolio, I can show you my CHK play. Long-term portfolio. So what do we have? 136 is, oh, same place. Okay, so that's good. CHK, here it is. So our CHK position is we have the $2 calls, and it's net zero, so you can start from scratch. We sold the $4 puts in 2020, and you can go to 2021 and do the same position. I wouldn't do next year. We have the $2 calls, which we will roll eventually into the 2021s. We sold the $5 calls short, and they're almost done practically. And we sold the $4 puts. So it's 50-50-50 the way we did it. The worst case is we had assigned 5,000 shares at $4 is $20,000 worth of CHK. But the net, because if you sell them, especially if you sell them now for 170, your net on a $4 put is 230. So that's where the stock is now. So I don't mind having 5,000 shares at $2.30. It's $10,000 worth of CHK. I like these guys long term. You just have to wait for natural gas to come back. And this, by the way, is the price that they're trading at in terrible, terrible natural gas prices. Natural gas, like I said before, natural gas can come back, you know, $1 easily come back $1 over the course of next year, and that will send these guys back towards 5. So that's how I play that. I would not play UNG. I would play CHK. JC says, I read the CHK said is 130% of the value of its assets. I don't care that's true of almost any real estate company. They're kind of like a real estate company. It's if they can service the debt or not. That's what matters, not whether they have debt. Okay, and value of assets is a weird thing. Again, when gas is $2.50, the value of their assets is half of what it would be if gas was $5. So if gas goes back to $5, then the debt goes to 65% of the value of their assets, or thereabouts. It's a simple way to look at it. What about Encana? Encana's not bad. If you like, I mean, you can do Encana too. The point is not to do UNG, but Encana, which is ECA, I think. But as long as they can service it, and as long as they're not going to be forced to sell when it's low, wow, Encana took a massive hit. I don't know what happened to them. But yeah, if you like Encana better, it's the same concept. It's just a matter of playing something that benefits from natural gas that isn't natural gas. That's the trick. What happened? I thought it was ECA. Oh, there it is. Encana. So Encana. Oh wow, that's erratic, huh? plus 3.4 minus 5 billion minus a billion plus 100 million. Are they heading towards a plus 3.4? I don't think so, because that was back when they're never going to do that. That's when they made $7 billion. So at this price, they assume that's irrelevant. That's hard to say, man. What are they doing quarterly? Oh, they're still erratic. They're going to head to a flat year this year. I don't know. That's kind of scary for me. I don't know that I think that's I don't think that's great. How about CHK? Well, let's see how dreadful CHK looks. Chesapeake, on the other hand, decline, but now turning around. This is what I like about them. They're turning around on sales. They're turning around that gross profit. It's huge. But again, they had the same thing. They whittled the company down. They took huge losses and write-offs, but it also means they're really not going to pay taxes for a very, very long time. They've got massive write-offs that they've got here. So they've got big losses here. But last year they made 953, and this year quarterly. See how they can better because they're making money. This includes they're paying their interest. Here's their interest expense right there. They're paying that. They can afford it, and they're making 294, whatever. Oh, we didn't look at that on the other guys, which was Encana, ECA. So if you look at Encana, see their interest expense, 80. So their interest expense is 80 million, 90 million, but they've got so much less sales and so much less gross profit. So, it's not about whether or not you've got debt, but whether you can afford to pay off your debt. You look at any builder in the real estate industry, they'll have a ton of debt, but it doesn't matter. That's how their business works. They're buying massive amounts of properties that generate no income, and then eventually they sell them, and then they make a lot of money. And then they borrow again to get back in debt. Chesapeake's like that too, and especially, it's not the same as it used to be. Aubrey was a crazy guy. The guy used to run. He got killed in a car crash. He was a maniac, but he was brilliant, and he would just balls out, just go. And when the market was down, he would go and buy up his competitors, and he would expand the company, and he would borrow to the hilt and whatever. And then when the market turned around, he'd start throwing assets out there and selling stuff and paying off all the debt. And the next cycle, he'd do it again. He was like a freaking conductor of a symphony. The way he would the way he would run that company, it was fantastic. And the new management is not as good, but they still do kind of the same thing. They've learned that lesson, that they buy when things are low and they sell when things are high. So they're gonna when you see natural gas prices, at all-time lows or long-time lows. Anyway, let's see monthly. Here's a monthly chart. When you see natural gas prices at long-time lows, this is when Chesapeake is not cutting back their stuff. They are buying more wells and buying more land and buying things that will produce in the future. And they will borrow and borrow and borrow to do that until they hold a lot of shit, waiting for the time, because they know inevitably it's going to go back up here, or at least up here, and they will make a ton of money. So, it's like a builder. It's like, when you say, you can't have a benchmark that says, oh, they bought 130% of their assets. That's like taking a builder who's doing $1 billion project, who borrows $900 million and puts $100 million in his own money. So now he's got no money in the bank. He's got a $900 million debt, $1 billion debt, and it's all for a piece of land that he hasn't built on yet. And you're like, whoa, he's got nothing. It's completely upside down. It's like, well, yeah, and 3 years from now, he's going to build a thing and we'll sell it for $2 billion and make $1 billion. But you got to let him do it. You can't say, oh, he's useless. It's like, that's how it works. So, and again, it goes back to, you've got to understand the mechanics of the things you invest in. Don't just invest in stuff. And don't try to apply criteria of things. You have to know the industries you invest in. If you don't, it's a very dangerous game. And and the best thing to do is to read. If you want to invest in a certain sector, the best thing to do is to read those annual reports. Not annual reports, the quarterly reports when they have the conference calls, and read what the CEO says and read what the analysts are asking him. Sometimes they ask good questions and sometimes he gives a good answer. And also read their annual report, because if you can't take the time to do that, don't invest in a stock. It's like you shouldn't invest in things if you don't have the time to find out what they actually do and how they make money. Because then you're just going to be at the whim of some random person who tells you this or that about something. And you don't want that. You want to have your own opinion and be able to make your own decisions. All right, so that's all the time I got, and I will do. Oh, we will not do this again next week. I'm sorry. We're not doing next week. The week after that, which is God knows when, sometime closer to the end of the month. 27th. So next time we do this will be the 27th, almost the end of February. All right, thanks for coming, guys. Have a good day.